Get Rich Slow with John Wolf. Hey, today's the big video that kind of ties in all of my videos about price shopping. But for this to make sense, you're probably going to have to watch my conventional loan basics and price shopping, intro to price shopping, and price shopping, how to compare written loan quotes. And today I'm actually going to show you the part that's really missing intentionally from the written loan quote comparison. Now, before I get in a lot of trouble, this is not a quote for you. I'm showing you what things look like so you're a smarter consumer. Alrighty, so what was missing from everything I told you before was two pieces of knowledge. First, all the things that were partial quotes and stuff I told you before, good faith estimates, they're not locked. The real money happens, or it stops changing and stops being a variable when you lock the loan. If I call you and talk to you and I tell you what your loan quote is right now, interest rates or the points and fees, not the fees, the points can change by a ton in one day. Sometimes they don't, but sometimes they move a lot. So this right here is what it actually looks like a decent amount of the time when I put all your information in and I want to find out, what your interest rate and points are. Now, all your fees from the written quote and stuff are off to the side, but when I talked about discount points, how much you have to pay to buy a lower interest rate is these red numbers on the far right column. And in the green, if you actually decide to take a higher rate, I can actually pay you money instead of you paying me money under the discount point section. But if I just pulled your information and I got this one right here, if you notice the 3.75% interest, it's the first green one. I have to give you a little bit of money. If you want to pick either that one or the next one down, I think that's probably a good decision, unless there's some special circumstance. But when you see those online quotes that I've showed you before, they want you to pay. You see that's the top one here is 1.6. That Quicken quote I've showed you before, they wanted you to pay 2 points. And if you look at the difference, like at 3.75, I have to pay you $440. And if we go all the way up to 3.375, you have to pay me $5,800. And that's upfront in your closing costs. So is that ever a good decision? Well, you kind of have to run the numbers. Usually the answer is no. So on this one, getting from those two interest rates is basically $6,000 cash up front today. And you save $76 a month doing that in this example, and this is a $400,000 purchase, just for the example. That would take you 81 months to make that money up in even dollars. I wouldn't do it. So when you're talking about refinances, the VA system has a guideline that you should save with a lower payment in 36 months what it costs you to do the refinance. Another guideline is you have to be able to pay for it within 60 months. Either way, we're way past that. I wouldn't do it. And part of what's not shown here is a lot of people refinance in less than that amount of time, but also there's opportunity cost with, what else could that money be doing? And there's the whole future value of money math. Now I'm going to show you an example where it's not simple like this. So right here, we have different loan type, happens to be all the same customer information in here, where if you notice, it's kind of weird. At 3.7, I have to pay the client money, but at these higher interest rates, the client actually has to pay me money to get those. And then at 3.05, I have to pay you money again. Obviously, unless I can think of a really important special edge case scenario, that 3.75 is what you want. Now, I want to show you an example of where you'd want to pay points, because if you actually do the same math we did before, we'll get sort of the same conclusion. So this right here is the exact same customer info that the one I just showed you was, where the 3.7, I actually had to pay the client. But this is someone whose credit score is 120 points lower. So we went from the customer getting, I think it was like $300, and here they have to pay $600 to get that. And the next freebie, the next green one, is all the way at 4.125. Now, the gap between that $300 towards you and that $600 away from you is basically $1,000. Let's just round. And the monthly payment difference is $89 a month. That means in 11 months, less than 1 year, that becomes a good decision. Well, in that case, you should buy the points every time. The moral of the story, just in general, is it's going to be a super, super narrow circumstances where it's a good idea for you to pay a bunch of points. And the reason why you see so many ads and so many clients get sucked into paying an entire percent of the loan up front or something like that is because the industry has hypnotized everybody to focus on the interest rate. And the reason they want you to focus on the interest rate is because I have the most games I can play on the interest rate as a lender. And so the lenders want you to focus on interest rate for the same reason that people who sell cars want you to focus on the monthly payment, because it leaves a lot of money on the table for the banks if you focus on the monthly payment. But what you should do, and go back to my video on the written quote, is you need to focus on the total costs, because that's what's really important to you. And costs now are worth more to you than costs later. That's just the way that reality and finances work. So don't sue me, bro. This is not a quote for any one person. To make it very, very clear, I quote people everyday interest rates that are a lot higher than what's shown on this sheet, and I quote people interest rates that are a lot lower than anything I showed on these sheets today. And none of this includes the closing costs and other fees you have to pay, but this is the raw pricing. So when you get a quote, if you don't have them lock the loan, and they'll send you a thing that shows where they locked the loan, then these numbers are floating. And by floating, I mean that, just so you guys know, in a one overnight, because they post new pricing every day when the market's open, the interest rates don't float around. It's these points that float around. You know, the left side of the chart is always there, and it's super common that the points change by like the points change by like 0.2 overnight, and they can easily change by like 0.5 during a day. Now, most of it is like the stock market, just seesawing, but there are totally trends. Anyways, like, share, subscribe, tell me what you think. Have an awesome day. And oh, I'm a loan officer in Oregon and Washington, so if you want a really tenacious guy on your side, hit me up, John Wolf. Take care.